Good morning, good morning, good morning. It is Friday, the 1st of August. July is gone. No one cares about what you did in July. No one cares about your performance in July. It's all about August now. You join myself and Mr. Michael Brown for the final morning blast of the week, where we will give a review of yesterday and a preview of today and potentially a look into early next week and give you some overnight news headlines, etc., etc., etc. I did send Michael Brown the wrong invite, so instead of being a co-host, he's now a speaker today. I apologise, Michael. Before we crack on, I'll get the legals out of the way. Nothing discussed on the Spaces session constitute trading or investment advice or infers any kind of endorsement by PIQ, myself, Ryan Paisley, or indeed Mr. Michael Brown. Hello. I can't hear him. Can anyone else hear him? Can anyone else hear me? Hello. Let's give him a message. Oh, he disappeared.
Is anyone there?
I am. Hello.
Ryan, can you hear me?
Yes, can you hear me?
Very good. Good morning to you, Ryan. Good morning, everyone. Not entirely sure what happened there. I had three invites from you, which I accepted, and then it still didn't work. So I don't know what
Ah,
went on there.
no, I did send you the wrong invite, so I'll take the blame on this. I sent you speaker instead of co-host by mistake.
Oh, I see. Well, never mind. We made it in the end. Very good morning, everyone, and a very
Exactly.
happy Friday as well.
Yes. Oh God, I'm tired. I'll be happy to get this week under the belt. To be honest, it's been a long one.
Yes, it very much has. Although we have 7 months of 2025 in the books now, as
Oh,
I heard you say a moment ago, August is already here.
not
How on earth has things gone by that quickly?
yeah, not quite sure at all how that happened, but yeah, yeah. Moving on.
Yes, indeed. Well, where should we start this morning? We may as well start with the issue of trade because it looks like sentiment is pressured rather considerably on both sides of the pond. Futures trading around about 1%, just over 1% lower on most European indices this morning, and S&P futures touching session lows down by 0.7% as I speak. And this comes after a whole round of fresh tariff announcements from President Trump overnight. Once again, seemingly no real rhyme or reason as to the tariff levels that have been imposed on various trading partners of the United States. This, of course, comes after, well, the tariffs that have been imposed are tariffs on countries that were unable to strike trade deals with the United States before that 1st of August deadline, which we have now passed and which was not extended. Not going to go through all of the levels because there's far too many of them, frankly. Some of the most notable include Canada, who will be charged a 35% tariff, Switzerland, who will be charged a 39% tariff. Not entirely sure where that number has come from, to be completely honest. That's way above what they were being levied before. Brazil, which is going to be subject to a 50% tariff, although there are a number of exemptions from that tariff, which means that only about 40% of Brazilian exports will actually be subject to that levy. We've also got India, of course, at 25%, and rather weirdly, New Zealand, which was previously being charged a 10% tariff, but has now been charged a 15% tariff. So not entirely sure what the Kiwis have done over the last few months to see their tariff rate increase, but nevertheless, that is what has happened. Personally, I would still be viewing these very much through the lens of negotiation.
Yes, definitely.
Yes, these are the tariffs for now. The question is, how long do we stay at these levels? And my gut feeling is we don't stay at these levels for particularly long. Although what I would say is, of course, you recall back at the start of April, we had all this talk of 90 deals in 90 days. Just to recap where we currently stand or where we've ended up on that front, it was actually 120 days and 8 deals, which doesn't have quite the same ring to it. And those deals that have been made, of course, the details on that front are very, very thin on the ground. A couple of other things on the trade front from yesterday. Firstly, from the US side, President Trump did extend the current tariffs on Mexico for another 90 days, so kicking the can down the road on that front. Meanwhile, on the China front, despite Treasury Secretary Scott Bessent saying he would talk about the China trade talks with President Trump yesterday, we still have heard absolutely nothing, as far as I can see, in terms of an extension or a potential extension to that China trade truce, which is, of course, as of now, due to expire on the 12th of August. Those talks in Sweden obviously wrapped up on Tuesday. Now it is Friday, so it's slightly concerning that we haven't heard anything on that front just yet, but maybe we will get something today. In terms of trade in the rest of the world, I mentioned the Kiwis. They are going to try and push to get that 15% tariff rate lowered. Not entirely sure how they're going to do that. Maybe they'll send some sheep to the United States or something like that. Also, in terms of the rest of the world, India, they are looking at how they can, well, according to Bloomberg sources, placate President Trump as a result of this 25% tariff that they have been slapped with, I suppose. According to Bloomberg sources, India is considering increasing natural gas purchases from the United States, also weighing the potential of increased imports of communications equipment and potentially gold as well in order to reduce the trade surplus that they are running with the United States. In terms of other bits and bobs yesterday, away from trade, markets were really sort of more of the same. The dollar extending recent gains, the dollar index trading north of the 100 figure for the first time since the back end of May, and also north of the 100-day moving average. In turn, that's seeing the euro test 114 to the downside. Cable trade briefly below the 132 mark, and dollar yen trade north of 150 and well above the levels that we saw on Liberation Day at the start of April, which feels like a hell of a long time ago now. In terms of other catalysts, we did have some more mega cap earnings after the closing bell yesterday. Amazon delivering top and bottom line beats, also marginally upgrading their guidance compared to where market participants had foreseen that. AWS sales also coming in better than expected. Amazon did pop about 2% on the print, but then sellers emerged and they were trading down by about 3% when I last looked. Apple, meanwhile, also delivering top and bottom line beats, also beating on iPhone revenue and Greater China revenue as well, which has been a little bit of a problem area for Apple of late. Apple traded about 3% higher after those earnings crossed last night. Sticking with corporate news, not much on that front actually this morning. The only thing worth noting really that I've got here is via Sky's Mark Kleinman, who noted yesterday that Klarna, the buy now, pay later firm, they are reportedly preparing to revive their plans to IPO on the New York Stock Exchange. That would be worth around 50, or value the firm at around $15 billion. This is due to take place in the autumn. It was meant to be taking place in April, but of course they shelved those plans amid the market turmoil that we saw in the aftermath of the original tariff announcements. And lastly, just to wrap up a little bit of data that we had yesterday, both initial and continuing jobless claims in the States coming in better than expected. Initial claims at 218,000, continuing claims at 1.946 million. Of course, neither of those prints pertains to the July non-farm payroll survey week. So, of course, that data is due later on today, which we'll talk about momentarily. And we also had the latest core PCE figures out of the United States as well. Core PCE rose by 2.8% on a year-on-year basis in June, above both the market's consensus of 2.7% and also the 2.7% that Fed Chair Powell had flagged at the press conference on Wednesday. Also note, actually, I don't have the precise stat in front of me, but core durable goods prices in the PCE number in the first 6 months of the year, they rose at their fastest pace in 3 decades, excluding the aftermath of the pandemic. So anyone out there who is saying that the consumer in the US isn't paying tariffs, well, they are, and there's your evidence for it.
Wonderful. Absolutely. Is that you done for the first half?
It is for now, yeah. I've got plenty more to discuss in terms of today, because it's a very, very busy day ahead, but I'll let you
Indeed
read
it
through
is.
Zach's little note first.
Indeed it is. So let me just rattle through some of the headlines from the overnight news roundup. As always, do follow Zach
And I know
Eisen.
Zach isn't here this morning.
No, he's not. He's probably, well, I hope he's busy working, doing something. But also, as usual, do subscribe to the Substack. Best way to keep up to date with all the overnight news headlines, yada, 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 yada. Starting off with trade, as Michael has spoken about already this morning, President Trump slapped steep tariffs on exports from dozens of trading partners, including Canada, 35%, Switzerland, 39%, Brazil, 50%, India, 25%, and Taiwan, 20%, pressing ahead with his plans to reorder the global economy ahead of on Friday trade deal deadline. Deadline with air quotes I'm doing quite now. Not that anyone can see that. Trump issued a separate order for Canada that raised the rate on Canadian goods subject to fentanyl-related tariffs to 35% from 25% previously, saying Canada had, quote, failed to cooperate, unquote, in curbing illicit narcotic flows into the US. Switzerland's government said on Friday it was assessing the situation after the White House announced its higher 39% tariff on Swiss imports to the US in an escalating trade war between the two countries. Again, as Michael said, no idea where this number came from. Every chance it was a dart thrown at a dartboard. Japan will continue to push the US to implement an agreed upon cut to automobile and auto parts tariffs to 15% from 25%. That's gone to its top trade negotiator. Macro news, top White House officials told a group of rare earth firms last week that they are pursuing a pandemic-era approach to boost US critical minerals production and curb China's market dominance by guaranteeing a minimum price for their products. I think if history tells us anything, when you start trying to manipulate prices, it always seems to backfire. Let the market find its own prices. Basically, the rule of thumb on anything like this. But anyway,
Yeah, absolutely.
Goldman Sachs's credit strategists are urging clients to hedge risks as yield premiums on global corporate notes tighten to their lowest since 2007. That's according to Bloomberg. Japan's finance minister, Kato, said on Friday that its authorities have been alarmed over recent foreign exchange moves after the yen fell to 4-month lows against the dollar. Not that they manipulate or intervene there, but one to keep an eye on.
No, never.
Wink, 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 nudge, nudge. China's Caixin manufacturing PMI returned to contractory territory in July as softening new business growth led factories to scale back production. Also, don't forget, we did see a pre-tariff kind of ramp up in that where people was front running. So an element of pulling back after that, I'm assuming. South Korea's export growth, that's stronger than expected in July, driven largely by strong demand for high-performance computing chips amid the AI boom. The IMF, their executive board, approved a $2 billion disbursement to Argentina on Thursday, a key vote of confidence, even as the government of Milei missed a key target, while the peso posted its worst month in more than a year. Geopolitical news, China accused the US of exploiting a flaw in Microsoft's email servers to steal military data and launch cyber attacks on its defense sector. Pot kettle black there, I think, from China, but there you go. Equity news, Amazon shares fell 7% on Friday in Europe after the company delivered an upbeat outlook for Q3 sales, but missed expectations on its cloud computing unit. iPhone sales, they've blown past Wall Street's expectations in June. The June quarter, as some US consumers rushed to buy devices before potential tariff-related price increases. Just on that, and it was our dear friend Cam that I saw post this today. Apparently, if you've got an iPhone, go update your software straight away because there's some massive security issues there. So they've ramped out an update. So I think everyone's got to update to version 18.6 or something like that. But anyway, get that done.
Good.
Apparently,
That'll take me about a week to work out how to do that.
Yeah, it took me about 10 minutes to find the settings on my iPhone. I'm not gonna lie. I wish I didn't
Oh,
mention
actually,
it.
on
Go on,
that, sorry,
go on,
I've meant to
go
say
on.
this yesterday. Big news from Pepperstone Towers for frequent listeners of the Morning Blast. I finally managed to print something yesterday.
Hey, well
So that,
done.
just in case anyone had been having sleepless nights over that, you can
Uh,
rest easy now.
was that pre or post your lunchtime bottle of wine?
It was pre, actually.
Makes sense. Makes sense. Um, moving on. Coinbase tumbled after the cryptocurrency exchange reported a drop in adjusted profit for Q2 as weaker trading activity offset gains in subscriptions and services. UK Supreme Court, they will announce a long-awaited ruling on car finance commissions on Friday. This could influence whether major banks face multi-billion-pound compensation bills. We have mentioned this probably a couple of months ago now about this is something that we'll be keeping an eye on, especially for the UK banking sector. TLDR is that banks have basically been a bit naughty in kind of getting this car financing deals through, and by paying dealerships commissions, etc., to try and force them through. And it looks like it's going to be, if anyone in the UK remembers that the PPI stuff, it's pretty much the similar vein to that, isn't it? It could be
Yeah,
I think Lloyd's are one of the probably the most in line to getting a massive hit.
Yeah, you're absolutely right. I mean, Bloomberg actually had a note out this morning that called it PPI on wheels, which is quite a nice way to frame
Yeah,
it, I
that's
think.
good.
You're absolutely right. Lloyd's and Close Brothers are the other one that are potentially quite in the shit over it, shall we say? There is, to quite a technical term, there is some chatter doing the rounds, though, that the Chancellor Rachel Reeves may intervene somehow and try and sort of overrule whatever the court ruling is today. So potentially one to watch there as well.
Cool. And
Not
finally for me,
entirely sure why the Chancellor thinks she can overrule a court, but there we go.
God, can you imagine? Um, uh, AIG, sorry, not AIG. IAG reported better than expected Q2 earnings on Friday as it bolstered its transatlantic routes despite fears of knock-on effects from Trump's tariff war. And that is it from me. Back to you in the studio.
Good to see things are taking off for them.
Hey,
Right, where are we today then? It's actually a very busy day ahead, certainly for a Friday, annoyingly so, really, because it's been a very, very hectic week, and I think we're going to have a hectic day to wrap things up. Just to cover off a couple of things that are going to be happening sort of throughout the day. Of course, with those tariffs having gone into effect or been announced overnight, we are likely to get plenty of headlines on the trade front, particularly as countries around the world react to whatever levy that they have now had slapped on their exports to the United States. We may also get the announcement of further trade deals. Who knows at this point? The other thing to bear in mind, of course, is hopefully at some stage we're going to hear about the US-China trade truce and whether or not that will be extended. So, of course, keep a close eye out for that. The other thing to bear in mind is that the Fed's pre-meeting and post-meeting blackout period that does come to an end today. We are scheduled to hear from the Fed's Hammack. She is a 2026 voter and will be speaking on Bloomberg TV this afternoon. The Fed's Bostic will also be speaking on CNBC later this afternoon. We're also at some stage today likely to hear from Governors Bowman and Waller. It is very much convention that if someone dissents at an FOMC meeting, they explain that dissent at the end of the blackout period. So do bear in mind we are likely to get some dovish commentary from those two at some point throughout the day. In terms of scheduled events, the data docket is jam-packed. In about 12 minutes' time, we get the final manufacturing PMI figures from the Eurozone for July. That index is expected unrevised at 49.8. And then half an hour later, we get the same final manufacturing PMI figures from the UK, which are also expected unrevised at 48.2. Then at 10 o'clock this morning, we have the latest flash inflation figures from the Eurozone. This data, of course, referencing July. Headline CPI, that is seen at 1.9% on a year-on-year basis last month, just below the prior 2% and also just below, of course, the ECB's 2% price target. Core inflation, meanwhile, that is seen holding steady at 2.3%. And money markets in the Eurozone pricing about a 50-50 chance of another ECB cut before the end of the year. Of course, a fairly sizable hawkish repricing there since the US-EU trade deal, which was agreed over the weekend. Moving on from that, the main event of the day, of course, comes at 1:30 this afternoon in the form of the latest US labour market report with the data referencing July. Headline non-farm payrolls, they're seen having risen by 105,000 in the month of July, which will be a modest slowdown from the 147,000 that we saw in June, although still above the break-even pace of jobs growth, which is around 80,000. And that's, of course, the rate of payrolls growth required for that to keep pace with growth in the size of the labour force. The range of estimates for the jobs print is as wide as ever. We have a low of 0, which comes from Santander, i.e. no jobs added whatsoever, and a high of 170,000. Leading indicators, though, are on net pretty positive, to be honest with you, although we haven't had any of the ISM PMI prints just yet. Initial jobless claims fell by 25,000 between the two survey weeks, while continuing claims fell by 9,000 over that period. The ADP number, which you need to take with a humongous pinch of salt, came in at 104,000, if anyone thinks that's of any use. There are, though, some factors to be aware of in terms of things that may skew the jobs number lower. Do recall, of course, that the June payrolls print was quite considerably pushed higher due to seasonal adjustments in the education sector. Of course, June is the end of the school year in the United States. A lot of teachers fall off payrolls as a result. The seasonal adjustments around that is always quite difficult. So that is likely to unwind and potentially be a drag on payrolls this time out. There is also, of course, the potential for higher federal layoffs and also for tighter immigration enforcement to pressure the figures once more, although that's more likely to show up in the household survey. I'll get to that in a moment. Average hourly earnings, though, meanwhile, they are expected to have risen by 0.3% on the month and by 3.8% on the year. Both of those would be just a tick higher than we saw in the month of June, although figures in line with expectations there would again reinforce the FOMC's now very long-standing view that the labour market is not a source of significant upside inflation risk at this moment in time. Moving on to that household survey that I alluded to a moment ago, unemployment, that is seen rising to 4.2%, up from a prior 4.1%. The unrounded print, for those who are interested, last time out was 4.1173, so it was a low 4.1%, but unemployment was dragged lower by a fairly sizable fall in labour force participation in June, so coming lower for the wrong reasons effectively. Participation this time out is seen holding steady at 62.3%. In terms of some context around the report, I think in terms of the knee-jerk market reaction, and of course do bear in mind that we're going in with risk appetite firmly on the back foot with S&P futures down 1% as I speak. The market reaction to the jobs report, I think, is likely to focus primarily on the macroeconomic backdrop as opposed to any potential policy implications of the print, i.e. if it is a good report, that is likely to be a positive catalyst for risk assets, and if it is a negative report, that is likely to be a pessimistic catalyst for risk assets. In terms of what this all means for the Fed, of course, Jay Powell at the press conference on Wednesday evening did sort of slowly but surely crack the door slightly ajar to making September a live meeting. But do remember that we get not only another jobs report, but two CPI reports between now and the next Fed meeting on the 17th of September. So I certainly don't think policymakers, well, unless your name is Chris Waller and you're trying to get the chair's job, I don't think policymakers on the whole will be overreacting to the data that we get today. And in terms of money market pricing, as we stand at the moment, markets pricing about a 4 in 10 chance that the Fed deliver a cut at that September meeting, with around 33 basis points worth of easing discounted by the end of the year. Once we've moved past the jobs report, we do have a few other bits of data on the docket as well. At 3 o'clock this afternoon, we get the latest ISM manufacturing PMI figures out of the States. That index is expected to rise to 49.5 in July, up from a prior 49, although still in contractionary territory. And also at 3 this afternoon, we have the latest University of Michigan sentiment data. This is final data for July, which is expected to be unrevised from the preliminary read of 61.8. A couple of other things from me just to mention lastly before we wrap up the week. We do have some earnings today. We are pretty much through the vast majority of earnings now, but we do hear from ExxonMobil and Chevron before the market open, which is obviously of interest for any of the commodity traders out there. And last but by no means least, standing reminder, of course, that there is potential for gapping risk over the weekend and when markets reopen on Sunday night / Monday morning. Of course, primarily focus will fall on trade headlines, but also geopolitics as well. This deadline to the Russia truce and potential secondary tariffs there continues to tick down. So that's just something else for market participants to watch. But I will try and end on an optimistic note because it is, of course, the 1st of August. It is, of course, Jobs Day. And I would imagine, although I don't want to tempt fate, but I would imagine that today, once we get through that jobs report, trade headlines permitting, probably marks the start of summer for the vast majority of desks out there. So you would expect things to thin out a little bit as we move into next week, but I don't want to count my chickens just yet.
Like your Barnet. Whee!
Oh, I knew you'd get that in.
It's been a while, to be fair. It's been a while.
It has, actually, yeah. It's thinned even more since you last mentioned
exactly. it. Well, actually, I do remember last night pulling up an old photo of you in the pub, and it's definitely thinned out since that one. But anyway.
Well, you say old photos, only 9 months old.
Oh, God. On that note, Michael, thank you for another fantastic week. You know how much I appreciate you doing these. I think it is brilliant. So thank you very much, my dear, dear friend. Listeners, thank you as always for tuning in. We really do appreciate you, and we really do appreciate all the feedback you get, as long as it's good feedback. If you've got bad feedback, poke it. Whatever you're doing today, keep it tight. Have a lovely weekend. Stay safe, and we'll see you all on Monday. Much love.
Indeed. Have a good weekend. Bye for now.